So the market is giving us a year of all time in 2026. A lot of investors are worried about the volatility and they're trying to wait it out until there's a little bit more certainty. Right now, however, I kind of see this as a buying opportunity. I feel like everything is on sale. There's so many large compounding machines that are currently down like 15, 20, maybe even more than 20% down right now. So I've been analyzing a lot of the companies hit by the SaaS apocalypse, the fears around the 2026, 2027 AI spend, and then, anything that's gone down in general. So the plan for today is going to be pretty simple. First, I'll share where the portfolio is currently at, and then we'll walk through some of the decisions I made in the meantime, some of the additions I've made. I also, ended up dollar cost averaging down in one of the positions I already hold, just due to the fact that it went down quite a bit. And I want to walk you guys through the rationale. If we go to Qualtron.com, we can quickly take a look at our portfolio. Currently, the value is around $2,700, but we're at net loss of $75. For me personally, this isn't a big deal because I know a lot of the companies I'm buying right now, I'm buying for the future. If we take a look at our holdings specifically, you'll note that I dollar cost averaged and I added another share of Amazon. I added 2 additional shares of Meta, and I added 5 different shares of ServiceNow. Taking a look at this Wall Street Journal article, Big Tech Accounting Creates a Blind Spot in AI Boom, the thing that really caught my eye was the soaring capital spending graph that they include. In this graph, it highlights various different big tech companies, including Amazon, that are estimating to spend over $3 trillion in CapEx spend. You can see why so many different investors are worried that if we're spending this much money, is there really going to be a positive ROI on this spend? If you take a look at Amazon's metrics quarter over quarter, you can see many of their revenue segments are continuing to not only grow, but accelerate. Take a look at some of Amazon's revenue growth numbers, specifically around AWS. Taking a look at Amazon, we can refer to their revenue by segment. And when we filter for just AWS, we're able to see how perfect their revenue growth looks. They have continued quarter over quarter to show that they are growing, and as you see in the last couple quarters, that growth is accelerating. In the most recent quarter, they were growing almost 24%. And then additionally, if we take a look at their customer commitments for AWS, you'll see that customers want their product more and more, and Amazon is currently supply constrained, which really shows that once Amazon is able to get all this AI infrastructure online, then they'll be able to take advantage and literally see that impact on their top line. Then doing a valuation analysis for a company, my favorite metric to use is discounted cash flows. Right now, I don't feel like that's the most appropriate for Amazon, just because they're going through a massive CapEx spend. And because of that, I think price to operating cash flows is a much better metric as compared to discounted cash flows currently for Amazon. Using Google Finance's AI research tool, you can see that Amazon's operating cash flows has continued to increase year over year over year for the last 3 years. Honestly, taking a look at from the 2023 performance to their 2025 performance, you can see that it's almost doubled, and it's continued to stay in between the 15 to 17x range. Currently, as of March 2026, it's on a little bit of the lower end of that range, and that's why it poses as a great buying opportunity. Next up, I'm going to talk about a brand new position, and this position is going to be in Meta. Meta and Amazon share a lot of similarities in terms of the bear case, which is all around their CapEx spend. Meta has promised that in 2026, they're expecting to spend around $135 billion to build out their AI infrastructure. And historically, sometimes Meta has not had the greatest guidance, let's just say, in terms of where they're putting all that money. If you take a look back at Meta's history, they blew quite a bit of money in the metaverse. But keep it short and simple, this time around, it's completely different. And the biggest reason is AI is already helping them grow their top line. One of the ways AI has really helped Meta so far to actually impact their top line is the recommendation system. Whether you're taking a look at their Facebook, Instagram Reels, Threads, AI is being used quite a bit to increase engagement time. And if you're able to keep your consumers on these apps longer, that means you're able to have more ad time and you're able to charge more ads as well. If we pull up Meta next and we take a look at their revenue, we can scroll and see that their revenue is continually growing almost 24% on an annual growth basis. That is insane. They're a Mag 7 company, one of the largest companies in the world, and they're still growing this fast. Additionally, taking a look at this other chart, family of apps, daily active users, the amount of daily active users that Meta has is absolutely insane. 3.5, almost 3.6 billion users using their apps on a daily basis. 3.6 billion is crazy. Despite leading in the growth in the Mag 7, Meta averages a lower forward PE than the average of the S&P 500 at forward PE of 19x. Also, don't forget Meta Ray-Ban glasses. They're part of their Reality Lab segment, and that segment, although it isn't as much as their advertising, it isn't insignificant either. This segment is almost approaching $1 billion in annual revenue. And lastly, the one thing I noticed that a lot of people don't talk about related to Meta is WhatsApp. WhatsApp has almost 3 billion users, and they're only generating about 15 billion in revenue from WhatsApp. I think that Meta has the capability of growing this number exponentially to at least 100 billion. So I think this is like a hidden call option within Meta that once they start taking advantage of and continue to progress and grow on this, it's gonna skyrocket Meta's valuation. Last but not least, the final addition to our portfolio is ServiceNow. While everyone is freaking out about the SaaS apocalypse, I've been looking at this company for a while now, and I think it's finally at a bargain. Plus, based off my research, I don't think ServiceNow is going to be affected as much by AI negatively as it is actually positively. Software stocks have been catching a lot of heat lately because of the idea of seat compression. Seat compression is essentially the idea that as AI agents become more and more efficient, employees are going to need less and less software licenses, thus reducing the revenues that these software companies can earn. But it's a little different with ServiceNow. A lot of the market is failing to consider the fact that ServiceNow is a systems of record company, not a systems of engagement company. To put this into layman's terms, think of it like a bank. A system of engagement is like the ATM. The ATM is at the front end of the bank and it's easily accessible, but also easily replaceable. Systems of record, on the other hand, think of those like the bank vault. Without the bank vault, you don't have a bank. That's the entire foundation the bank is built on. You could probably replace an ATM on the weekend, just get a brand new one in, like integrating a new AI agent for other software companies. But for ServiceNow, them being the bank vault, it's much harder to just take away the entire foundation of all of the platform a company runs on. Flipping over to ServiceNow, we can quickly take a look at their revenue growth and some of their free cash flows per share as well. I mean, have you ever seen a prettier revenue growth chart than this? It's literally perfect. So they're growing their revenue year over year by over 20%. And then if we go down to their free cash flows, we can quickly take a look and see that on an annual basis, they're growing their free cash flows by over 44%. In the software space, this is unheard of. ServiceNow is achieving something called the rule of 55. This rule pretty much states that they're growing revenues greater than 20% and they're growing their free cash flows greater than 35%. In the software space, typically 40 is considered exceptional and 55 is considered legendary. I mean, this is why ServiceNow has a retention rate with the customers of over 98%. This is super high and uncommon against some of their peers, for example. Plus, another bull case for ServiceNow is their Now Assist program. This platform allows their consumers to integrate AI into their platforms as well. This platform is going to be generating almost $1 billion in revenue by the end of the year for ServiceNow. I don't think AI is going to be disruptive in the sense that people are going to leave ServiceNow. It's going to make some of their services a lot more attractive for customers, and it's actually going to make them want to stay on ServiceNow longer. With all of that being said, with everything going on in the market, I'm not planning on waiting. I think this is a great opportunity to buy really good, high quality companies at a discount. And if a lot of these companies or even other high quality companies continue to discount, I'm going to be a buyer. But I want to hear from you guys. Are you guys dollar cost averaging down with this volatility? Are you guys buyers? Are you guys planning on waiting and seeing what happens? Like, what's your guys' plan with your money? Let me know down below. And as always, remember to stay hydrated. All right. Thanks, guys.